Hi, Clint Coons here with Anderson Business Advisors, and in this segment I'm going to discuss how to take your personal residence and turn it into a rental. Now you might be wondering, why would I ever do that? Well, there are people out there who are considering turning their personal residence into a rental property. They don't want to sell it. It's in a location they think is going to continue to appreciate. It can produce great rental income for them. But the question is, how do you do it? Do you just move out of your house and then start renting it out? Well, you could do that, but you're giving up a tremendous tax benefit if instead you chose to structure it in a slightly different manner. Now, I want to show you is how you can take your personal residence, turn it into a rental by selling it to your own business and the tax benefits that come from that. So let's look at this example right now. Let's say that I bought my house 15 years ago for $200,000. So this was my purchase price. Now, today, my personal residence is worth $500,000, okay? So if I turned around, I took that personal residence and I turned it into a rental property, then I can start depreciating my tax basis. So my tax basis on this property was $200,000. That is what I paid for it. So the depreciation on this house that I have right here would be based upon a $200,000 basis in that. So that would get me probably somewhere around $8,000 a year in depreciation. So if you want to increase the depreciation, because if you recall with rental real estate, if I'm renting this out and I bring in $20,000 a year in rental income, I'm able to write off my depreciation against that, and that leaves me with $12,000 of positive cash or positive income that I have to pay taxes on. Well, I don't like these numbers right here. I want to increase that $8,000. In fact, I want to double that number. Well, there's a way to double that number without really doing anything different other than creating the structure and selling the house to an entity. So here's what we do. We take your property and we will create a S corporation right here. Create an S corp. You're over here and you have this house right here. So we will sell it to the corporation. Now, of course, you're in this corporation. That's your business. You're going to sell your house to your corporation. Now, you're going to sell it on an installment sale, all right? Now, if you're not familiar with installment sales, the way it works is that when you sell something on an installment sale, you're going to bring the money in over time. So let's assume we put this on a 20-year installment sale. So I'm not going to receive all the funds up front. I'm going to receive them over 20 years. Now, we want this to qualify for Section 121 as well. That is, you can sell your property and exclude up to $250,000 or $500,000 in gain if you're a married couple. So by selling this personal residence to our corporation, we're going to lock in that 121 gain on the sale of our house. Because remember, the corporation is not you. It's a separate taxpayer. So by selling to this corporation, I can still qualify for 121. So I sell my house now to my corporation. Now, when I sell to the corporation, if the corporation is going to buy it from me on an installment sale for $500,000, then the corporation's tax basis is what it paid for the house. It paid $500,000 for this house. So when the corporation takes the property over here, we're no longer at this my tax basis that I had if I just turned it into a rental. My tax basis now is $500,000 in the hands of the corporation. So here's what occurs. The corporation, if it brings in $20,000 in rent, it has about $17,000 in depreciation. That leaves only $3,000 in income. Versus in my prior example, if all we did was just turn it into a rental, we had approximately $12,000 in taxable income on an annual basis. So we just cut your taxable income by approximately $9,000, and all we did was sell the property to an S corporation. Now, that's great right there, but we did sell it. So here's where it gets even better. So since you sold the property to your corporation, and we're going to qualify it under Section 121, so we can exclude up to $500,000 in gain, and remember, we have $300,000 in gain here. Now, when I sell it, I am going to, in the year of the sale, opt out of installment sale treatment. That means I'm going to tell the IRS, yes, I sold it on an installment sale, but I want to treat all that gain in the year of the sale. So you're going to get taxed on this $300,000. But since you can sell a house and exclude up to $500,000, you have no tax liability personally. So As we progress forwards and this corporation starts making you payments every year, let's say it's paying you each year under this installment sale $15,000 a year, that's non-taxable to you because it's part of this sale. So up to $500,000 will be paid back to you out of your corporation, and you don't have to pay tax on it because you qualified this as a sale of a personal residence under Section 121. You're probably sitting back going, wow, that seems kind of complicated. It's not. It's actually relatively simple. So if you're considering selling or turning your personal residence into a rental, think about using a corporation. Call us at Anderson Business Advisors and we can help you out with this exact same strategy. Or check out our Millionaire Tax Strategies workshop where we go into strategies like this and 57 others on showing you how to reduce your taxes if you're a real estate investor or small business owner. My name is Clint Coons with Anderson Business Advisors.